Today I'm going to show you an amazing option strategy that generates income whether the stock moves up, down, or sideways. Yes, you heard that right. It's called the wheel strategy, and the best part is it's simple, effective, and repeatable. My name's Marcus, and I've been investing in the market for around 10 years now, and I've noticed one main thing. A lot of traders try to predict the market, but they end up just bleeding red every single month trying to do that. I've tried a lot of different options trading strategies myself, and this one is by far the best for this one reason. Time works for you, not against you. Let me explain. When most traders start trading options, they gravitate towards buying an option because they want the value to increase over time. This is incredibly hard to do over a consistent period because you need the correct speed, timing, and direction, as opposed to the wheel strategy, which is what we're going to be talking about today. As long as time is passing by with this strategy, you are making money. To put it simply, all you're doing with the wheel strategy is you're agreeing to buy 100 shares of a stock if it reaches a low price. And if it reaches that low price, you can agree to sell your shares at a higher price and get paid to do so on a weekly basis. Don't worry, if that was confusing to you at all, I'm about to explain exactly my 3-step process on how I collect weekly cash flow. We'll start by explaining exactly how I set up everything on my end, and then we'll run through an example together. So this graphic explains the wheel strategy overall, and this is exactly what we're going to go through together today. So the first and by far the most important first step is to select the correct stock. And there are a lot of things that go into this. You can't just pick any stock. So let's get into that. So first we need to filter for the correct stock. So in this case, I do like to select large companies in order to take ownership of them if they drop to a certain level. So in this case, we're going to choose a large market cap. In my case, I like to choose at least $1 billion in market cap or higher for these companies. They want to be well-established companies you don't mind owning for the long term. So that's the first thing we're going to change on our stock screener is the market cap level, at least $1 billion or higher. The second thing we're going to change is the implied volatility. Basically, what the implied volatility says is how much the stock is projected to move in the next 12 months. So the higher this number is, the more it's likely to move. The lower this number is, the less it's likely to move. We want this to be in a range between 40% and 80%. I've tried a lot of different ranges. This one works the best as far as the premium collection on the stock itself. You can change this depending on your risk tolerance of the stock itself. I've had success with this range here. So we're going to select 40% to 80% for the implied volatility on the option screener as our second option. Third, we're going to take a look at options average volume. This is very important because you want to be able to get in and out of your contracts when you want. You want there to be enough liquidity within the contracts themselves, where if you do want to exit at any point, you can do that if you would like. So in this case, we need at least 5,000 options contracts traded on a monthly basis for there to be enough volume around the contracts themselves. That is the third thing we're going to change with the screener itself. And lastly, we do need options available. That's pretty self-explanatory. We can't trade options if the stock itself doesn't have options available. Fifth, we do have to take a look at the share price. So this is going to be dependent on your account balance because of the fact that you do need to be able to buy 100 shares of a stock, and that can get expensive. I do like to allocate between 10 and 15% of my total portfolio balance to one stock position. So in this case, I have an example between $10 and $50 stock. This would be between a $1,000 position and a $5,000 position because each contract needs to have 100 shares of the stock within it. That is one contract. That is how options works. That is a non-negotiable. Once you have set up all of those filters within your screener, a list of stocks like this will populate on the side. So realistically, what you should see is around 80 stocks that meet this criteria, depending on what you set your share price to be in that fifth step. So every single one of these stocks that populated on this list meets every single one of the criteria we set up earlier. As you can see here, it is sorted by market cap. So the largest market cap stocks are at the top, and it descends lower as they go lower. These stocks are all good candidates for running the wheel strategy according to the criteria we set up together. So once you've chosen a stock from this list that you're comfortable owning for the long term, we're going to choose our entry price, which is actually the strike price of the cash secured put. So we're going to come down here, we're going to actually pick the most optimal strike price together. And these are things I look at in the stock itself to give me a better understanding of where the stock is trading in relation to where it has been trading over the past few months. So here, we're going to choose the most optimal strike price. I use two main indicators to choose the strike price of my cash secured put. The first one is the Bollinger Band. And basically what the Bollinger Band shows you is it creates a 2 standard deviation range between the 20-day moving average. And so what that's going to tell you is where the stock is likely to trade within during that time period. So here you can see the length is 20 for the 20-day moving average as the middle. And we have 2 standard deviations of data set up in this certain criteria. This tells us where the stock is likely to trade within a very short period of time. I personally like to trade weekly options. That is the first indicator we will use in order to pick our strike price. I'll go into more detail here in a second on how we can use that. Next, I do like to use the 30-day moving average. That just tells us where the stock is trading in relation to where it has been trading over the past 30 days. Ideally, we want to agree to buy the shares below the 30-day moving average. So here's an example of what those would look like on TradingView. So these blue rings, as you can see here, the top, the middle, and the bottom are all part of the Bollinger Band. And realistically, we want to agree to buy shares at the very bottom of the Bollinger Band. And what this is telling us is about 95% of the price movement will stay within these blue bands. So if the stock is already low, very close to this blue band, you can see right now it's at 239. Ideally, we want to agree to buy the shares at around 233, where this bottom blue ring is sitting. So that's the most optimal entry price because it's very likely to bounce up back into the blue range once we agree to buy those shares. So here, that is kind of the first thing I like to look at is the Bollinger Band. Can we agree to buy the shares at the bottom of the Bollinger Band? Next, I like to make sure that the stock is under the 30-day moving average. As you can see here, this red line is the 30-day moving average. It is under that value, which is a good sign for us. So next, we're going to actually agree to buy the shares at this low price. So here you can see, like I said earlier, the bottom of the Bollinger Band's at $233. That is the most ideal entry price for us at this time. So here we're going to choose sell put. We're going to choose about a week till expiration, and we're going to actually enter that position together. So what we're doing here is we're agreeing to buy Amazon if it drops to a lower price. So as you can see here, these are the strike prices we can choose from. So each strike price has an associated premium next to it. So this is the strike price, 232.5 for example, and the associated premium we can collect if we agree to buy 100 shares at that $232.5 price is $115 of premium. This is in 1 week. So that equates to about 0.5% return just in 1 week of agreeing to buy the shares. So here we're going to select the $232.5 strike price. And the reasoning we're selecting that specific strike price is because it's very, very close to the bottom of the Bollinger Band. It's actually just below it. Here you can see the bottom of the Bollinger Band's at $233. So we're going to choose the $232.5 strike price. We're going to collect $115 up front for agreeing to buy those shares. So as you can see here, what will happen is either the stock will expire above 232.5, which in this case is a good example of what would happen. So here, this is an example of just another stock we did an example with, but realistically what would happen is the stock would expire above our strike price. In this case, 13.85 is above the $12 put strike price that we originally chose to agree to buy the shares at. So this is a good thing because all of this premium that we originally collected, $115 in our example earlier, is ours to keep. We collected that. We will not have to take ownership of the shares. We are not assigned if the stock stays above this value by the time of expiration. And like I said, I like to choose weekly expirations. Okay, let's now go over a worst case scenario. So let's say you do actually have to take ownership of these shares because the stock drops below $232.50 on the day of expiration. In this case, you are assigned the shares. So here, you would sell that put, you would get assigned, and so we would actually go all the way down here where now I would own 100 shares. And so instead of $253.64 in this example, it would now say I own 100 shares at 232.5, which is our original entry price or strike price of our cash secured put. So now, since I own those shares, I can actually agree to sell my shares at a higher price, which is called a covered call option. Since I now own those 100 shares, I'm gonna agree to sell my shares at either the price I bought the shares at or above my entry cost. So here, as an example, once again, let's say we own the shares, we can now sell a call option. We're gonna choose a week till expiration, which is the time frame I like to personally trade weeklies instead of monthlies or a couple weeks in general. But here we can see our entry cost is 232.5. We're agreeing to sell above that value because we want to get some potential upside in the stock itself. So here, as you can see, this as the strike price goes higher in value, the premium we're going to collect when we agree to sell our shares at that price is going to be lower. For example, there's a higher chance that the stock will reach $240 rather than $242.5. It's trading at $238 currently. So since the stock's already trading above our entry cost of $232.5, we're going to agree to sell our shares at a price higher than the current market price. In this case, let's choose the $245 price. So in this case, you can see one of two things can happen. Realistically, either the stock can stay below the strike price we choose, which in this case is $245. We collect $146 of premium for agreeing to sell our shares at that price. One of two things can happen. We keep the premium regardless. Scenario one is we're assigned on our covered call. In this case, we get the cash back in the form of cash, and we can basically realistically do this all over again and sell another cash secured put. So here's an example of when I was assigned on NVIDIA on April 17th. I agreed to sell my shares at 185 in this specific example. The stock went all the way up to $201. I still have to sell at $185 because that's the contract I entered at the beginning. The second thing that can happen is you are not assigned on those cover calls and you're able to keep your 100 shares. In this case, this is another example specific to SoFi. So on June 12th, I sold a $18 cover call option. On the day of expiration, the price was $16.58, which is below $18. So I keep my 100 shares I already owned, I keep the premium payment that I got up front, and I'm able to repeat this process by selling an additional cover call in that second week. So realistically, every single Monday morning, I can adjust my strike price for that given week depending on where it's trading. So in this case, I chose the $18 price because it was likely trading around 16 or 16 and a half, and I wanted some potential upside in the stock, but I still wanted to collect a large premium for agreeing to sell my shares. So in this case, our entry price was $232 and a half. We want to sell above this. So in this case, we would select a strike price above $232 and a half to agree to sell our shares. Like I said earlier, the premiums are larger the closer you go to the market price. You're getting compensated more for agreeing to sell your shares at a lower price. So if the price at expiration is above our covered call strike price, in this case $201 is above $185, we are forced to sell 100 shares that we own at $185 per share. And you can see all of this value goes back into my account as cash. It is a credit of $18,500. So once we are assigned on that cover call option, our stock does get called away. And what that means is we now have additional cash to work with to sell an additional cash secured put. That's why it's called the wheel strategy, is because you can do this over and over and over again to collect this premium payment, whether you're selling a put option or whether you're selling a covered call option. Since I've been running the wheel strategy for the past 2 years, I've made about $45,000 just in premium payments so far. And realistically, all you're doing is you're just agreeing to buy shares at a low price. You're getting paid to do that, and then you're agreeing to sell those shares you may or may not take ownership of, and you're collecting a premium for doing that as well. So all of this profit is literally just from premium payments I receive for agreeing to buy and sell shares at the prices I choose. If you want to learn a little bit more about how you can get started using the wheel strategy on your own and start to get these sort of profits, you can actually book a free meeting with me using the link below, and we'll just talk through your situation if this is the right strategy for you moving forward.